Hi, this is Lara at Elliott Wave Gold with your end of the week video analysis for the trading week ending Friday the 12th of January. The main wave count expects a trend change here in a new bear market to last 1 to several years. The target is a very low 463. However, before we can have any confidence at all in this view, we need to see a new low below 1324.93, and then we need to see a breach of the Elliott channel on the hourly charts by downward movement. While we do not have those two conditions met, we cannot have confidence in a trend change. And so I'm presenting a new very bullish alternate that will expect upward movement. If we can see a new high reasonably above 1357.09, then that would have confirmation. We can expect overall upward movement. Okay, let's have a look at the weekly chart. This is the main wave count. It's the main wave count because it has the best fit. All the subdivisions fit very well. It fits the most common tendencies. It meets all Elliott wave rules. All of my wave counts see this big fall in price from the September 2011 high to this low in December 2000, or end of November actually, 2015. As a 5-wave structure. So all of my wave counts are making an assumption that this wave down here, ending here, subdivides as a 5. What that means is, if that's correct, the bear market can't be over there, because corrections do not subdivide as 5s, they subdivide as 3s. And so this would be just wave A of a 3-wave structure down. So we would have A ending here, B beginning here, and B unfolding. This all fits perfectly as an Elliott wave regular contracting triangle, the most common type of Elliott wave triangle. It also fits as a classic analysis symmetrical triangle at this stage. Elliott wave triangles have 5 subwaves. 4 of the 5 subwaves must be zigzag or zigzag multiples, but only one of the 5 subwaves can be a multiple. One of the 5 subwaves doesn't have to be a zigzag, it can be some other kind of 3-wave structure, but they are almost always all zigzags. Here we have a zigzag for A. This upward movement, importantly, does really look best as a 3-wave zigzag. It fits best as a 3-wave zigzag. We have a zigzag down for B. This fits really well as a zigzag. A double zigzag up for C. Seeing this movement here from this low to this high as a complete double zigzag has, by quite a long margin, the best fit, and it has no problems in terms of rare structures. You'll see what I mean when we get to the alternate weekly charts there. The most common triangle subwave for an Elliott wave triangle to be a multiple is wave C. So not only does this wave count have the best fit, but it follows the most common pattern for this structure. A zigzag down for D has a really obvious 3-wave look to it at the weekly chart level, and now a short, sharp upward wave for E so far has fallen short of the AC trend line. That is the most common point for E waves of Elliott wave triangles to end. If they don't end there, then the less common but next likely place for them to end is with an overshoot of the AC trend line, and when they overshoot, it's usually not by very much. E waves of triangles can be remarkably brief, and they have surprised me before, so let's not be surprised here. This is entirely possible. It could be over at Friday's high. We could see a quick reversal and a huge wave down beginning. The most common Fibonacci ratio for wave C to exhibit would be equality in length with A. That's why I've used this calculation to calculate a target at 463. For an Elliott wave triangle, wave E may not move beyond the end of wave C above 1357.09. Let's take a look at the daily chart now with the end of primary D. This point down here, from this low to this high, this upward movement has a pretty good 3-wave look to it at the daily chart level. Intermediate wave B is over much more quickly than expected, but sometimes E waves of Elliott wave triangles can be over much more quickly than we expect, and here is a really good example. Within this zigzag down for primary D, it subdivides 5, 3, 5. We classify a triangle as a 3. I know that's a bit odd because it's actually 5 waves. But here, when this triangle came to an end, wave E, remember, ended quite a lot more quickly than we had expected. That could be happening again at a larger fractal. It's entirely possible that primary wave E could be over at Friday's high, or very soon with just a little bit more upward movement. But before we can have reasonable confidence, we need breaches of the channel at the hourly chart level. What I don't want to see here is to try and label from this low to this high. This is a 5-wave structure. I don't want to try and label it 1, 2, 3, 4, 5, because when you draw a trend channel around this piece of upward movement here, which would contain 1 and 2, this movement here breaks below the lower edge of that channel. If this was a 4th wave, it should be contained within the channel, not breaching the channel, most likely. So that just doesn't have the right look. I think this is a quick primary wave E, and I think we might have a high in place, but we absolutely need some conditions to be met before we can have confidence in that. Extending triangle trend lines on out, sometimes the point in time at which they cross over, you can see a trend change. It doesn't always happen, and it doesn't have to be a trend change at a major trend change of a high degree, but we'll look out for some kind of trend change on the 4th of February. That's the point in time at this stage where those triangle trend lines cross over. Let's take a look quickly at all of possible primary E from the low down here, this point down here. 1, 2, 3, 4, 5 has a good fit. We have a good ratio between 3 and 1. No ratio between 1 and 5. It's just a little bit too far off equality in length with 1 to say there is a Fibonacci ratio there. This movement here fits really well as a zigzag. We've got a little contracting triangle in here for the B wave. And from this low to this high, we have again a complete 5-wave structure. 1, 2, 3, 4, 5. 4 perfectly touches the end of wave 1. The rule is 4 may not overlap wave 1 price territory. It does not overlap, it touches. There's no overlap. All Elliott wave rules are met. The subdivisions for 3 are perfect. This is an Elliott channel drawn from the start of A to the end of B with a parallel copy on the end of A. If we do see some more upward movement, if C does continue higher, look out for it to find strong resistance at the upper edge of that channel. It can't move above 1357.09. Any movement by any amount above that point will immediately invalidate the main wave count. At the hourly chart level, let's look at the end of B and the start of C, this point here, 1, 2, 3, 4, 5, and the 5th wave has perfect subdivisions. We have a bearish engulfing candlestick here, but it's only at the hourly chart level, and this candlestick here has a bit of a long lower wick. So this certainly could be not the end of upward movement, and I have an alternate hourly wave count which looks at that possibility of it continuing. The alternate would be invalidated with a new low below 1324.93, and that's why we need to see a new low below that point before we can have any confidence whatsoever that we may have a high in place. But what we really need to see is clear, strong downward movement breaking below the lower edge of this Elliott channel. When we have that, then we can have reasonable confidence that we have a high in place. While we do not have those conditions met, we absolutely must accept that we have no evidence yet of a high in place. We have to wait and be patient to see that evidence before we can have any confidence at all in this hourly chart. The alternate is the same up to this point here, and then I've simply moved the degree of labelling within the last wave up, down 1 degree. Minor wave 5 most certainly could be extending. We could have only minute 1 and 2, which could move a bit lower. It can't move beyond the start of 1, below 1324.93. And so if we get more upward movement on Monday, then this will be the preferred wave count. We'll be expecting, while price remains below this invalidation point, that this main wave count is correct, that we're looking for a trend change coming up very, very soon. Let's have a look at some alternates. It's all the same to this point here. I'm still assuming that cycle wave A has subdivided as a 5-wave structure. And now what if cycle wave B is not a triangle? What other structure could it be? It could be a single zigzag, but we'd have to see this wave up here subdividing as a 5-wave structure. And the problem now becomes there's a great disproportion between intermediate 4 lasting 12 weeks and intermediate 2 lasting only 2 weeks. Now sometimes within gold's impulses it can have disproportionate 2nd and 4th wave corrections, but it's usually the other way round. It's usually the 2nd wave which is more time consuming and the 4th wave which is quicker. Here's a really good example. Here's a disproportionate 2nd wave and 4th wave correction. That happens because gold, typical of all commodities, likes to exhibit swift, strong 5th waves. And when those fifth waves are swift and strong, they can force the fourth wave correction that come before or after to be more brief and shallow. And that's what's happened here in this fall in price here. This fourth wave is much quicker than this second wave. This case has it the other way around, which is actually quite unusual for gold. It doesn't follow the most common tendency. And so I think that reduces the probability of this wave count. There's another problem in here. If we're seeing cycle B as a single zigzag, we have to see the subdivisions 5, 3, 5. From this low to this high, we cannot see this upward movement as an impulse, but we can see it as a zigzag, which means that primary wave C could be an ending diagonal. Within an Elliott wave ending diagonal, all the subwaves must subdivide as zigzags. The classic equivalent is a rising wedge, and here this movement will subdivide as a zigzag, but here's the problem. In order to see it as a zigzag, subdividing 5, 3, 5, we have to see minor b here as a double flat correction. And in my almost now 10 years of daily Elliott wave analysis, I think I've only ever seen, in what in hindsight was definitely a double flat correction once before. I think they're actually one of the rarest Elliott wave structures. I think they're actually rarer than running flats. And so that again has to further reduce the probability of this wave count. But here's the problem about probability, which I really do hope most members and traders will understand. Low probability does not mean no probability. Low probability outcomes absolutely can and do occur, but the problem is the nature of probability. When they do occur, they are never what you were expecting was most likely. And so Elliott wave analysis, to be done properly, should include alternates, particularly when you're close to points of resistance and support and the analysis, classic analysis, can be unclear. An Elliott wave alternate wave count can tell you what's most likely going to happen next if your main wave count turns out to be wrong. So you rank them in order of probability. My main wave count is ranked as most likely because it has the best fit in terms of subdivisions, the least problems in terms of no rare structures, and it fits most common patterns. This wave count has to be judged to have a lower probability because it has a problem in terms of subdivisions and rare structures. If we're looking at an ending diagonal, we have a zigzag for 1, a zigzag for 2, we need a zigzag up for 3, which must move beyond the end of 1 to meet the Elliott wave rule for the third wave. And then we'll have a zigzag down for 4, which must overlap into wave 1 price territory and can't move beyond the end of 2. That's the rule for a fourth wave within a diagonal. And so within the zigzag for 3, it should subdivide 5, 3, 5. Minor wave A could be over here, it could be continuing higher. When minor B turns up, it can't move beyond the start of A, below 1236.54. This is another alternate, and I'm publishing this to illustrate why for a bull market scenario, we need to see movement reasonably above this point. I'm just going to quickly go back to that last weekly chart, my bullish wave count. In order to have confidence that we are in a bull market, we need to see 3 move reasonably above 1357.09. Now, while a new high by any amount at any time frame, even in a fraction on a tick chart, is enough to invalidate the main wave count, it's not enough to provide good confidence in this bullish alternate, because this is why. Here's another alternate. What if cycle wave B is a double zigzag? The first zigzag in the double, labelled primary wave W, resolves the problem of the disproportion that last alternate has. Now we're seeing it as a 5-3-5 zigzag, and this upward movement does look best as a 3-wave zigzag. So this could be the end of the first zigzag of a double zigzag for cycle B, and this could be where W ends and X begins. X could be a triangle with a 3-wave structure for A, a double zigzag for B. Now again, we've resolved the problem of the rear double flat in here, a zigzag down for C, a zigzag up for D could be complete here. We still need to see a zigzag down for E, most likely to fall short of the AC trend line. So for the short term, expected direction for this alternate is exactly the same as the main wave count. If price can turn reasonably before 1357.09, both these wave counts will remain valid, the second alternate and the main wave count. This does not follow the most common pattern for an Elliott wave triangle though. The most common wave to be a multiple is wave C, but here the multiple is seen as wave B. That's okay, all the rules are still met. It's just that guideline of the most likely wave to be a multiple isn't met. That's okay. C isn't always the one to be a multiple. It can be B as well. But here's the problem. For an Elliott wave contracting triangle, D may not move beyond the end of B above 1357.09, but for an Elliott wave barrier triangle, D should end about the same level as B. What that means in practice is that D can end slightly above 1357.09. As long as the BD trend line remains essentially flat, then an Elliott wave triangle will remain valid. And unfortunately, that's the only Elliott wave rule which is not black and white, which means for this wave count, this invalidation point is not black and white. This point can be breached a little bit on any time frame, and then price could turn around and move lower, and this wave count would remain valid. I'm just going to go to my daily chart and show you, because there's a really good example here of a barrier triangle. Here it is. Within this upward movement here, we had a 5, 3, 5 zigzag, and here's a barrier triangle. The BD trend line remains essentially flat, although D ends very slightly above the end of B. This is how this movement subdivides best. All the subdivisions fit very nicely down to the hourly chart level. A good example there of a barrier triangle. Not the most common type of Elliott wave triangle, but entirely possible. And so that could happen again. D could end slightly above this point, and this wave count could remain valid. This wave count does still require an imminent turn and another wave down in order for it to remain valid though. Okay, let's step back and take a look at the weekly chart for some classic analysis, and let's see if there is any evidence of weakness in this upward movement. We've got the last 2 weeks of upward movement coming with an increase in volume. Volume supports the rise in price, that's bullish. The longer lower wick on this weekly candlestick is bullish. It's broken through resistance. Next resistance is about 1345. Overall, gold does still remain range bound with resistance and support swinging up now to resistance. So it looks reasonable to expect this upward swing to come up to meet resistance about 1345 and then probably to turn. There should be strong support again on the way down about 1305 to 1310. That has been respected here, and so that resistance and support was again strengthened a little bit then. On balance, volume has broken above resistance, so it's given us a bullish signal. It's not exhibiting any weakness. There's no divergence with price. ADX is still below 15 at the weekly chart level, so it's too low to tell us that there is a trend yet, and the positive and negative DX lines have been whipsawing about each other, typical of a consolidation. ATR continues to decline and be very, very low for many, many months. This actually offers quite a lot of strong support to the Elliott wave triangle. It's exactly the kind of behaviour you'd expect to see as a very big triangle comes toward its conclusion. RSI is neutral, there's still room for price to rise or fall, and MACD is still quite bullish. It's just now, stochastics is still bullish, but only just now entering overbought. And so the picture at the weekly chart level is still quite bullish and still exhibits no evidence of weakness that we should be using to indicate an end to this upward swing yet. Only when stochastics has moved further into overbought and then preferably exhibits a little bit of divergence with price would we then expect an end to the upward swing and look out for a downward swing, while ADX is still telling us there is no clear trend. What about the daily chart level? Is there any evidence of weakness here? No, well, a little bit. No evidence in terms of volume. These highs with price come with divergence between price and stochastics, but no divergence that I can note, or not clear strong divergence between price and RSI. Now if we saw divergence here and with stochastics, I'd be calling for a high in place, but there's no divergence between price and RSI to indicate any reasonable weakness here, only with slow stochastics. That's not enough to indicate that we may have a high in place, and so it must be accepted that we certainly could see further upward movement next week. My main wave count comes with a strong caveat that hourly chart channel must be breached before we can have confidence at all in that trend change. We don't have confidence yet. Divergence between price and on-balance volume has simply disappeared. On-balance volume is very bullish. Volume is bullish. RSI is overbought, but there's no weakness, so we'll read this as still bullish. It can remain overbought for quite a long period of time when gold has a bullish trend. ADX is telling us the trend is now extreme. It's nearing 35. If it gets above 35, it would be very extreme, but it's above both directional lines, and so the trend, the upward trend at this stage, at the daily chart level, is extreme, but that certainly can continue for several more days before price turns. On its own, this is not an indicator that upward movement has to end. Obviously it isn't. It's continued already for a few days. It can continue further. ATR showing a very slight increase, but overall still essentially flat to declining. I've noted divergence with stochastics while it's overbought as well. It's often a reasonably good indicator of an end to a movement, but like I said, I'd prefer if it existed along with RSI as well. At the end of this movement, Bollinger Bands are still contracting, so there's just a little bit of weakness there, and MACD remains fully bullish. So overall, the trend is now nearing extreme. There is a little bit of weakness, but it's not yet extreme enough, and there is not enough weakness to have confidence of calling a high in place. The bottom line is the trend is up. We should assume the trend remains the same until proven otherwise, and so I'm giving some specific trading advice to Elliott Wave Gold members on how to handle this uncertainty in your trading next week. That's all for me at the end of the trading week with your gold analysis, and I hope that all of our members are having a fabulous weekend.